What does it take to grow your business in Africa? Not only in scale, but impact. Not only for now, but for connecting to a future rich with opportunities. It takes bravery, imagination, and the will to get it done. It takes a financial partner that understands and supports your vision. One with over 150 years of Pan-African experience, who will go to extraordinary lengths to exceed your expectations and to challenge limits across borders, languages, and cultures. What does it take to turn an investment opportunity in Africa into something exceptional? To turn a project into a legacy that you can be proud of? It takes one of Africa's largest listed banking groups, a leader in corporate and investment banking in African capital markets, with the ability to leverage a tailored combination of an on-the-ground presence in 12 African countries, coordinated coverage in others, and global offices in London and New York. What does it take to bring possibilities to life and unlock value in Africa? To solve complexities and deliver depth of insight and relevancy to changing conditions, it takes a deep understanding of investment flows, market participants, sector trends, and regulations on the continent, and a comprehensive suite of products in your key industry sector. It takes innovative solutions, a future-thinking financial partner that's in it for the long term, and African ingenuity. It takes bravery, imagination, and the will to get it done. It takes Absa Corporate and Investment Banking, your financial partner in Africa. The bravery to imagine and the will to get things done. That's Africanacity.
I'm Kobus Esterhuysen. I'm at Peresec. I'm going to moderate the session on international investment. I'll start with Andre Bret. He's living and working in Paris, capital fund management. He's vice president of research. He started his career as a lawyer and then went to economics. And you will later hear some of the interesting ways in which they do research. Andre, if you can maybe just quickly tell us what you do in 2 sentences, what makes you unique?
So, yes, thank you, Kobus. So when I say systematic quant fund, we're a fund that plays diversification, really. So we are in the position of using large amounts of data, apart from price data and fundamental data, but what we call in industry alternative data. So that's anything from satellite data to measuring the greenness of crops, for instance, by using very sophisticated methods to predict yields of crops, etc. So CFM, as you said, we're a systematic quant fund. We manage about $8.5 billion US for mostly corporate and public pension plans in US, Europe, Canada, Asia Pacific. And the real key distinguishing thing of CFM is this ability to use large amounts of data and be very diversified, but not only diversified in terms of asset classes, within asset classes, geographies, etc., but also in terms of informational input. So we can cover anything and everything that's out there, and we have a larger breadth of information that we can incorporate. And I think maybe just a second thing is we're a very academic, collegial type of firm. So we've got standing academic chairs and sponsorships with some of the best universities in the world. Try and be at the forefront of academic research and finance. So I think those are the 2 things that distinguish us.
Thanks, Andre. Over to you, Matthew. Peregrine Capital, quite different. We most of us know Peregrine Capital. I'd broadly classify you as a deep value fund manager, so taking not an opposite but a different approach from Andre. What makes you unique?
Oh, so I think it's working. I'm definitely not the first Peregrine Capital employee to be sitting up here. We've been going for over 22 years now. So I think what makes us unique is our ability to analyze highly complex situations globally. I mean, as you may be aware, we run a couple of local hedge funds. We've also recently launched a global long-only equity product. And I mean, in our hedge funds, we really can take advantage of any asset class globally, bonds, equities, commodities, and we thrive in complex situations and very difficult special situation opportunities that arise. So, as you said, deep value. I wouldn't necessarily say deep value, probably more fundamental bottom-up analyst. So that's pretty much what we do.
Yeah, well, good. Wilhelm, you call yourself a value investor. I know you have roots going back to RCM, which is well known for their very vocal value investment. Rozendal Partners, a relatively new hedge fund, but well known in the industry for value investment. Over to you. Maybe just what would make you different from some of the other well-known value investor hedge funds in South Africa?
Thanks, Kobus. So we are bottom-up fundamental valuation-based. It's the term we prefer to use rather than just value managers, which isn't that unique in the industry. But I think what really distinguishes us from many other firms in the industry is our dedicated effort we've made to structure the firm to be as aligned with client interests as possible. So it goes from shareholding in the firm to employees and shareholders of the firm being heavily co-invested in the funds that we manage, and also our fee structures where we have performance fee clawbacks if there are subsequent years of underperformance. So, I mean, we obviously consider ourselves to have the skills on par with the rest of the industry, but I think what really sets us apart, to my mind, is our alignment between owners of the firm, employees in the firm, and clients. And I think that's of paramount importance for a client who makes a long-term commitment to a firm. So really that's, I think, our distinguishing characteristic.
Yeah, thanks. And over to Claire, it's slightly different. She's at Asset Consultants, Sukha and Associates. As an asset consultant, sort of where do you differentiate yourself relative to many other competitors and quite large and sophisticated and successful other asset consultants?
Thanks, Kobus. So I think the key thing that differentiates our business is really that we only provide investment advice. So we're not selling product. We are not creating funds to put our clients into, but we provide truly independent advice, and we earn an advice-based fee, not a product-based fee, which allows us to really look at each client and which strategies are best for that specific client, to treat them all individually.
We just quickly want to touch base on trends and themes in the international financial markets. Now, we're a little bit overwhelmed by what's happening in Russia. We're going to push that slightly, sort of crystallize that out to later discussion in this. But just maybe, Claire, while we're with you and your asset consulting, sort of the international trends and themes that you've seen pre-Russian war that may have changed anything. How do you see it playing out, sort of the world economy and where we're heading with investments if we're looking forward?
Sure. So I think, before Russia invaded the Ukraine, we were already at the start of an energy crisis. So we'd already seen the oil price escalate due to geopolitical tensions as well as some other factors. And we'd come through COVID, and we'd had the post-COVID recovery. And I think the outlook really shifted to one where growth became a little bit more uncertain. We saw inflation starting to spike in several regions around the world, and there was the question as to whether this was temporary or was it a more structural change in inflation, and growth was potentially starting to slow. So I think questions came about were there certain sectors, if we look at the US and the tech sector specifically that had run hard, were starting to become overpriced. And in addition, did we need to start worrying about a potential stagflation scenario? And I think recent events and the oil price now escalating over $130 a barrel has made that stagflation scenario a bit more of a likelihood. It potentially had a lower probability before, but I think the chances of that have now increased. And in January, we saw quite a dramatic sell-off. I think the S&P had its worst January since the global financial change in the outlook and the opportunity set going forward.
Yeah, thanks, Claire. Wilhelm, maybe on a more sort of a micro level, we hear about the green economy, renewables, agricultural investments, commodities. Are those any of the themes that you would explore globally, or do you stick to the old guard?
No, those are certainly themes we would explore, and one can't ignore those themes in allocating capital and in coming to a conclusion as to the future prospects of a business, even if you are a bottom-up investor. So I think of those themes you mentioned, certainly call it the green economy, ESG, sort of resources, and the impact that has had on capital allocation is of overwhelming importance, often in many industries. So I think one has of late seen capital actively flowing towards, call it clean energy, renewables, that type of thing, and away from old dirty energy like coal, oil, etc., which probably has contributed to the bit of a supply crunch we've seen in those markets even before this whole Russia situation. And I think as somewhat contrarian investors, we've certainly taken cognizance of this, let's call it capital flows being directed to areas where economic returns is maybe of importance but of secondary importance, and potentially that creates opportunities for those focused purely on the economic returns. And I think we'll probably talk a bit later about the sort of ethics and the morality of allocating capital, but leaving that aside for the moment, we certainly think that has created opportunity and will probably continue to create opportunity going forward.
One of our largest opportunities last year was exactly what he mentioned. I'm not sure if you're aware, but Anglo American unbundled their coal company, Tungela Resources. And I mean, you chatted to everyone. No one wanted to touch it. There were global investors. Why would we want to own a coal company? It's a ESG unfriendly. The world is moving away from coal. So we actually found, I mean, it's one of our best performers ever. We did a lot of work. I think the first day it traded down from 30 Rand all the way down to 20. We took a 5% position in the company, and it's trading at 160 Rand where we sit today. So these opportunities do come when other market participants shun investments, and as a sustainability perspective, South Africa still needs coal, and clearly Europe still needs coal at the moment. So I think everyone wants to phase out and become more climate friendly, but as an investor in capital markets, you do have to be aware of all of these big shifts and where the opportunities arise.
Yeah, Andre, you have a different worldview or way of engaging with it. What type of trends would you highlight? I mean, you also have sitting in Paris, maybe have a different perspective on what's happening in global markets.
Risking repeating what everybody has already said, but as I mentioned, in terms of our approach, we take an extremely diversified view on markets. So clearly, even before the Russian invasion, we've been fortuitously positioned in many of our commodity futures exposures. What we've noticed is that the recent commodity cycle, and I guess the jury's out on this, but the recent commodity cycle has had some unique features compared to previous commodity cycles in that it's been much more broad-based. And there's very good reasons for this, and it's probably going to remain in that there's clearly an energy crisis. People here are much more knowledgeable on perhaps looking at investment in single stocks, but there's underinvestment in many energy products. And what is going to happen in Europe is clearly they're going to double down on renewables. I don't think anybody's doubting that the European Union is going to accelerate their desire and ambition to become or to hit the emission targets. But what is going to happen is that they do need still hydrocarbons, and they're going to switch to more hydrocarbons. So you see a parallel in both those commodities, typically metals, that is going to be needed for the transition, the coppers, the nickels, the cobalts, etc., that are going to be in high demand, but in parallel, some of the hydrocarbons as well. So there's a very broad-based rally, and we expect this to continue. Big caveat, we don't make macroeconomic calls, but we follow as the data comes in what is likely going to happen, and this is what we expect to happen. Now, linking this to sustainability and something Wilhelm said, I think we are very skeptical of the ESG label. So we have to make a very distinct, clear distinction, but I think what we mean by ESG and what we mean by sustainability. Now, ESG, there are various issues that we have with ESG as a label, as well as the way that people go about ESG, the way that people use metrics, the way that people use data. There's a lot of biases in the data. There's market cap bias, there's sector biases, there's greenwashing, there's self-reported anomalies, etc., etc. So we prefer not to rely very heavily on some of these ESG data providers, and we've written extensively about this. We've published academic papers on this. We don't see any price formation based on this data. But we are very focused and bullish on sustainability. And how we try to do it is we try to, in the equity space at least, identify those companies that are clearly going to be beneficiaries of the sustainability to transition versus those that will not. And we use things like network analysis to assess the greening or the browning of neighbors within a network across a wide swath of global equities, rather than focusing on specific sectors. So again, to our DNA, we look at diversification to identify winners and losers in the long-term sustainability trend.
Thanks. We're quite sort of on a time constraint, but I do want to ask one question to any panelist. If there's none, then we move on. Anyone sort of focusing on the open finance, DeFi, crypto space? Is that you actively look at, or for now see it as just a bubble that's going to burst, or how do you engage with the whole sort of crypto DeFi world?
Yeah, I mean, I think something that's very clear to us when we talk to global execs, a lot of people from offshore technology companies, a lot of their top talent is leaving to work in the crypto industry. And I mean, that really does say something. It means that there is possible, the potential for disruption to a lot of, standard technology companies could come from their crypto economy. So it's not necessarily saying crypto equals Bitcoin, is that there are these new platforms being built on decentralized networks that run on the likes of Ethereum, Solana, and other kinds of tokenized platforms, if I can call it. So it is something that we are acutely aware of. And then just on the Bitcoin itself, cryptocurrency, I think the world was quite surprised that the US did not let Russia access the central bank deposits at the US Treasury Reserve. And if you are a central bank sitting in any other country, does this not worry you? And I think there is a potential that Bitcoin does become an asset that central banks will start looking at to allocate over the next 10 years. And I think, the longer something, stays intact, they call it the Lindy effect, the longer something is working or exists, the more likely it is to exist going forward. So I honestly don't think it's something that we can ignore as market participants.
Yeah, I'm sure there's a lot more to say, and I know there's a session later on cryptos or the whole DeFi, so I'll cut it short for time. Just before we move to Russia, and we'll try and take a slightly different approach to Russia, I'm just going to give each panelist an opportunity with 1 minute to pick either a stock or a sector or a region, and just motivate something that's exciting. Clay, if we can start with you, put you on the spot, what would be sort of a wild idea that you think other people may have missed?
I don't think it's necessarily a wild idea, but it is an area that I think has been underfunded, and that's within our local economy. So keeping it at home and looking at infrastructure. I think that there are so many areas that require funding, so many worthwhile projects that will deliver investors good market-related turns. Sometimes those are linked to inflation, so great for long-term institutional investors. And we've seen that the market has been really slow to allocate capital here. There definitely are risks, but I think those risks can be well managed. And if you're selective with the projects that you look at, it provides a great opportunity.
Wilhelm?
So the top holding in our global fund is uranium miner Cameco. So uranium is a commodity which we're still excited about. The price has moved up alongside the rest of the energy complex of late. But it's still quite reasonable relative to incentive prices when new production is incentivized to come to the market, etc. So we're quite excited about Cameco, and by implication, uranium as a commodity. We think there is a definitely greater scope for the use of nuclear energy in the clean energy mix of the future. And it's something which capital has, up to date, been slow to flow into because of the overhang from Fukushima and all the, let's call it the headlines one sees about nuclear, which is actually a very clean and safe form of energy. So we think for the longer term future, uranium is a great place to be.
So I'll also talk about something a little bit different in our portfolio. So it's a Swedish company called Evolution Gaming. So they're an online live casino operator, B2B business that provides live online content to the likes of Betway, Sunbet, and other regulated operators that operate globally. So they effectively, if you look at the online live casino gaming market, if you want to go and gamble or entertain yourselves, you can go to Monte Casino, Grand West, and that's still around 91% of the overall market. And if you go to a table and there's a dealer playing blackjack, per dealer, there's about 4 or 5 people that can play the game. Whereas online, Evolution is one live dealer, and on that specific live game, there can be 3,000 or 4,000 individuals playing that game online. So the scalability of this model is absolutely insane. We've seen margins in this company go from 30% to over 70%. And as the world kind of opens up to online gambling, as we see in the US, where the markets are becoming more regulated, there's just immense opportunity for something like this that can go from 9 or 10% online penetration to over 30, 40, 50% over the next 10 to 15 years. So that's one of our longer term companies that we really like in our portfolio.
So not to beat a dead horse, but as I mentioned in terms of diversification, we think we are much better at aggregate than we are at nailing the next 100x company. So we are not in the business of finding unique stock picks globally that we invest in. In any event, we've got rather strict caps in terms of positions that we take on both our long and our short side. Something perhaps I would mention, and I'm sure it will be discussed at length during today, but when we look at markets today, I think clearly there's a perfect storm of sorts. Commodities, inflation, and when I say commodities, the whole complex from energy to food. We've done some interesting studies on looking at 150 years worth of data and how most asset classes perform under certain stress scenarios, specifically within inflationary regimes. Now, our research shows that there's some worrying things happening. The first thing is that inflation expectations are becoming unanchored. the Fed is in a real bind. We expect inflation to go up. It's inevitable that it's going to go up with energy prices spiking, but there's also the shelter component in the US. And we track consumer data through credit card data in the US, as well as sentiment. And we think inflation has still got a bit to run in the US. But some of the research shows that when inflation expectations become unanchored, something that we look on a macro scale is that the bond equity correlation, i.e. the co-movement of bonds and equities, tend to become less negative. And you've seen this if you look at the US, for instance. If you look at on, say, a 20-day exponential moving average, you see that bond equity correlations have not only become positive since COVID, and on a few occasions, it's currently hovering at zero. So if you are an investor with a diversified portfolio, say a 60-40 or typical 70-30, etc., we personally think you're in a real pickle. The ballast or the protection that you're going to gain from fixed income going forward is definitely less than certain. And clearly, as a hedge fund, I think we are advocating for investors to consider historically stable, uncorrelated assets, to especially your fixed income component.
Thanks. All good, and some good ideas. Now we're moving on quite briefly to Russia. We're trying to put it into a small time slot, and I'd love us to take maybe a slightly different view on it. We think a lot of analysis and reading, and everyone is up to speed. What I would like, maybe Claire, starting with you on the other side, is the ethical element of people saying, but disinvest from Russia. But we're also custodians of investors' money. We have managed. We're supposed to maximize returns. How do we handle the tension between huge opportunities maybe opening and maybe sort of more in general in any event broader than just Russia doing, because it also asks the question about sort of local ethical questions. Just the ethical element, how would you advise your clients in terms of negotiating the tension?
Thanks. So I think, the ethical element is always a difficult one to negotiate, because ethics links to people's values, to their morals, and those can be different. Different people have different priorities. But I think when we look at Russia specifically, since 2014, the risks of investing and allocating capital in Russia have been heightened, and that's something that we've been cognizant of ever since Russia annexed Crimea. The impact of sanctions and the impact that those sanctions could have on businesses within Russia have become greater, and I think investors need to be cognizant that yes, a company may be cheap, but it may also be cheap for a reason, and as the risks have grown, as we moved into the start of this year, and the tensions started building, what we saw was really, some managers looking at it in terms of it being a black swan event, that Russia would invade the Ukraine. But the reality was that over time the risks have heightened and heightened, and I think that it got to the extent where actually the risks were greater than any potential reward that would come out, and we've seen now that Russia's become completely uninvestable at the moment. So I really do think, when you look at the ethics, there's E, there's S, and there's G in ESG. So, it's not as complex. It's not as easy as saying we're not going to invest in fossil fuels because we believe in the E. But, fossil fuel companies employ a lot of people. There's an S element to it as well. So I really feel it's more about assessing the risks in a more holistic manner and risk managing your portfolio accordingly. And yeah, Russia has become uninvestable.
If I can maybe comment, echoes Claire's views to a large extent, but certainly in terms of the ethics of these calls for disinvesting from Russia, I'm not entirely sure that will necessarily achieve the purpose, because if you look at Russian public equities, which currently you can't trade, so it's a moot point, but assuming you could, if you, out of principle, sell out to other investors at the prices these stocks have been trading at in the past week before the exchanges closed, you are transferring massive economic value to the buyers of those shares. Buyers of those shares are people potentially less constrained by ethics than you are, and you are in effect bolstering those players. So for all we know, the Russian insiders are buying these shares for cents in the dollar from Western capital and effectively benefiting at the expense of Western capital, and that really defeats the object of Western capital disinvesting from the Russian market. So I think one needs to be very careful when casting these moral judgments on whether it's right or wrong to be invested in Russia or not.
I mean, that's definitely a fair point, but you assume that there will still be value in these businesses going forward and that they won't collapse and cease to exist.
The gas reserves will still be there. They may not have the same owners that they have today, but the gas reserves and the oil reserves will be there.
Good point. Matthew, may I change slightly away from ethical and just ask, how do you, in your investment process, include these war-type events? I mean, war is one, but I mean, you very much a bottom-up, if I may say, investment. Where at what stage do you like pull the trigger and say, guys, we're now in a different sort of environment for a temporary or a long-term period? How do you include wartime events, including Russia, in your whole investment process?
Look, it's been very difficult, and we also still trying to understand, what the implications are. I think the only thing you really can do is prepare your portfolio for a wide range of alternative outcomes, which really is the case right now. You can go from anything from, Russia will pull out tomorrow and they'll come to a truce to an all-out nuclear war. I think the nuke option is something that we haven't really prepared for, because I think if that happens, all bets are off the table. But it's the same as going into COVID. I mean, we were fortunately able to protect our portfolios going into COVID. It was more of a grey rhino event that you could almost see it coming. I guess you could have seen this one coming too, but it's one of those macro events that I think a lot of people just didn't see unfold. But I think being alive to what's changing and not becoming overly bearish when things don't go well, because if you go and sell out today and you lock in some of your losses that you've maybe incurred over the last couple of months, that's just not how we run our funds. And in the same scenario, you also can't just keep buying as things retrace. You do have to take into account what's happening to your companies, what the likely effects are, and I think just on a daily basis continue looking at your companies and whether your thesis is playing out as to what you expect.
Yeah, Andre, just quickly at your point, do you see it as a point of inflection? Do you see it as a more 9/11 down and up again, and in a quant fund, how do you adjust your modeling for these sort of once-off events?
Firstly, I've never heard the term grey rhino.
Black Swan, so it's kind of like
I thought it was
not completely out of nowhere, but
yeah.
The
African black swan. No, it's great. No, I think what we're basically talking about is tail risk. So in a quantitative fund, in the way that we call it, have downside protection, is in all our investments, we obviously have predictors that feed investment decisions systematically, without any intervention, post-research and post putting into production. So the way we deal with this is we cap our predictors. So and our predictors is also volatility weighted. So we've got volatility estimators of future volatility. Now volatility has various nice features that you can predict volatility much better than you can predict price. Volatility is autocorrelated, all of the rest. So what we can do is we can weight our predictors across all our asset classes by limiting the impact that any of our predictors will have in any of our investment decisions. So again, it's a different approach and different investment process than the guys on the panel. But we are inherently protected through these capping and through these diversification for large tail risk events. And in addition, we also trade volatility. So we've got volatility arbitrage sleeves in our flagship fund, as well as directional volatility. So not only do we protect, we also try and exploit these tail risk events.
Thank you. We have about 5 minutes left, so we're about to wrap up. The last section, I'll get a little bit more personal with my panelists. I want to know from them what they've learned personally from investing in international markets. It's always sort of getting feedback from the outside world back into yourself. So sorry, Claire, if we can put you at the spot again. I know that you also in your sort of free time work and NPO that assist youngsters to wrap up their CVs and apply for jobs, which clearly has been motivated by living in South Africa. But how does your work and investing in international markets benefit you as a person, or have challenges for you?
So, sure, difficult question, but I think, from being in the markets for a very long time now, I think you learn that nothing is ever certain. So no matter how secure you think the future is, the road is never straight. And so I think what I've learned personally is never put too much faith in how you think things are going to play out, because all likelihood that things are going to be different to what you expect. And I think the benefit that brings to our clients when we deal with them is that, when we look at their portfolios, it's to really make sure that you are considering diversification from all angles. So, not just whether you're in different listed geographies, but also whether you're in listed or unlisted assets, the different equity strategies that you follow, the different fixed income strategies that you follow, but also that, risk is only viewed holistically if you do incorporate elements of ES and G into it, because the ultimate sustainability of your investments is important for long-term investors, and that's really where the risks come in.
Yeah, thanks Claire. And by the way, Claire has a long lifetime goal of planting 1 million trees. So if anyone wants to donate a few extra trees to her, you're all welcome to contribute to that process, Claire. We really hope that you're successful. Wilhelm, over to you. You sort of also director on the Free Market Foundation, so obviously living this notion of free markets and how important it is. Your perspective on how your job influences your personal life and how you integrate those.
Well, I think to me the greatest challenge investing globally has probably been to accept that one has to be comfortable with uncertainty and not knowing everything. By nature, I think most analysts, especially bottom-up analysts, are inquisitive people with inquiring minds. They want to know as much as possible about something to get to the answer. But the wider your investment universe, the less you are able to get to the final answer in any specific situation. You have to learn when you have enough information to make an informed decision, and when you actually need more information, knowing that you can never know it all and that you'll have to live with an element of uncertainty in making investment decisions. That's just an inevitability of the job, which certainly, I guess, took me some time to get comfortable with.
Matthew, and I know that you're quite a keen cricket player. I've tried to get all of your stats online, and I've discovered some impressive numbers, which I won't share because it may look me bad. But how do you sort of transfer this passion for a sport and the challenges that brings back into your work?
We often compare sports to investing, and especially in a year like this year, which has been fairly tough. We just say sometimes it's best to just hit singles, get all the small wins rather than trying to go for the big swings to kind of get your numbers significantly better. So I think that's probably the biggest comparative to cricket that I can find.
Yeah, well done. We do know Peregrine Capital. Andre, over to you. Last but not the least, I know that you engage with senior people doing interviews. I've read some of the stuff. Really interesting, sort of engaging more outside the investment world. How does that benefit sort of your investment process?
Yes, I think I've been. We are in a privileged position to have access to many of the most forward thinkers, or in fact historically, and it's always nice to have a soundboard. Because you can easily become entrenched in your way of thinking. You can believe your way is the best and there's no other way. It does echo some of these comments in that we work in finance, and I think it's one of the most complicated, not complicated, complex industries to work in. And yes, and perhaps you cannot know anything, but there's a trend, I think, in finance where the amount of information and data that we're going to have and have at our disposal is making that uncertainty of knowing everything much smaller all the time. But nevertheless, when you become entrenched in your own way of thinking, it's always good to have a soundboard, a very orthogonal soundboard, to give you access to new thinking, or perhaps just kill your ego a bit.
Thanks, guys. That wraps up our session. I hope you've got a few nuggets of wisdom. If you need any more, engage with these people. If any of you are fluent in French, get Andre in the side room and practice some of that. Thanks for your time. That's us, and we will move on. Thank you.
Infusion, an open front-to-back investment management platform designed specifically for the cloud with one unified dataset, accessible on desktop, mobile, and web. Infusion, the wisest investment you'll ever make.